Right then, good afternoon, folks, and just another update from us at the end of another busy week of trading. We'll start with the calendar, then we'll jump over to some markets and we will see what we can find. And a week of inflation. I've only got the high impact data releases up on the screen at the moment. There's a couple of medium impact ones that we need to take note of as well. But you see inflation, right? A week of inflation prints out of the Eurozone. You can see French inflation, French CPI. Previous 6%, consensus 6.1, an actual of 6.2%. So higher levels of inflation across France. We also had a higher rate of inflation, a higher CPI print out of Spain, higher CPI print out of Italy as well. So pretty strong inflation out of a number of different economies throughout the Eurozone. We then come into Germany on Wednesday at 1 o'clock, as you can see here, and again higher than consensus. Not higher than the previous month, but higher than consensus. And in terms of the month-over-month figure, a 1% increase in the CPI print over the course of February alone. So inflation still continues to rise, and inflation still continues to prove troublesome throughout the world. We saw a bit of a sticky inflation print last month out of the US, and we'll be waiting for another one in a couple of weeks from themselves. Inflation then again out of the Eurozone, slightly higher. Eurozone as a whole slightly higher. Obviously, if we get higher prints out of Germany, France, Spain, and Italy, naturally then the Eurozone as a whole's inflation is going to be higher than anticipated, right? Consensus for 8.2, actual was 8.5, and it means that the ECB need to keep the foot on the gas in terms of rate hikes, which is then an interesting play going forward. It means inflation around the world, CPI around the world, continues to be slightly sticky over the course of the year, and it is not coming down in the way that these central banks would hope or had hoped with the incredible levels of interest rate hikes over the course of last year, which then is a little bit tricky, right? It was then a little bit tricky, and it means a need for higher interest rates, which is slightly tricky. I mean, you look at the Fed, you look at the ECB, and you look at the Bank of England, right? The three major central banks, and all three of them are kind of sticking to the same script. Global central banks. For them three mainly, if I'm talking about them three mainly right now, they are sticking to the same sort of script, right? They are all saying that they are going to be data dependent going forward, that they are data dependent, but they do not want to make any knee-jerk decisions off the back of a couple of different data points right now, right? They all took a lot of measures over the course of last year, hiking interest rates, winding down QE, introducing QT in order to cool down the pace of inflation, right? And they want to let that take effect before making any knee-jerk decisions on any higher or lower prints over the course of this year. So although they are data dependent, they do want to wait and see if their measures from last year can take effect in the way that they had hoped, right? And then think about, what does that mean going forward, right? What does that mean going forward for financial markets? In my opinion, that then means that there's the toss up then. Are they willing to accept higher levels of inflation, right? Are they willing to kind of be behind the eight ball in terms of levels of inflation, which they were all behind the eight ball in terms of raising interest rates to stop inflation from happening? They allowed that to happen, and now they're in a situation where I think the plan, certainly from my point of view, is that they are allowing, or going to allow, inflation to run hot, or allow the possibility for inflation to run hot over hiking these economies into recession, right? They don't want to hike, they don't want to over hike and hike all of these economies into recession and cause massive problems then going forward. They want to allow what they've already done to take effect, right? But that then says to me that they are going to allow a higher inflationary environment. They are going to allow inflation to sit higher than their target ranges, right? Which is obviously not good for the consumer. But that's what they're balancing up. They're balancing up between allowing inflation to run hot or crippling the economy in terms of interest rate hikes. And I think they seem as if they are going to allow inflation to run a bit hot. And then you got to ask yourself, what type of assets are worth trading? I mean, you got to think, in that environment, if that does play out, if they do allow inflation to run above target, you got to be buying gold then, haven't you? I mean, you got to think about gold with it being an inflation hedge. If inflation is allowed to run hot, yeah, that's a clear buy of gold in the coming weeks and months ahead. And if they allow that to happen, which in my opinion is what they seem to be allowing to do. So my eyes would be peeled on gold going forward, and I think yours should be too. But we'll flick across to the charts, and we've had a pretty bond yield driven week. We'll stick it back on the 4-hour chart. As you can see, the uptrend across US bonds continues. US 2-year, US 10-year and US 2-year continues higher. German 10-year, German 2-year continues higher. The UK 10-year, the UK 2-year continues higher over the course of the last number of weeks, and that has pushed higher again over the course of this week. Sorry, especially US bonds, US 10-year, US 2-year continuing to push the highs. US 2-year nearly reaching 5% at its highest level since 2007, right? And that is off the back of expectations for higher interest rates, off the back of higher levels of inflation, right? And then what does that do to other markets? You come across the indices, sorry, stick this back on the 4-hour time frame, and that downtrend across stocks has continued over the course of this week, certainly across the US indices, with the S&P pushing lower over the majority of this week, the Dow Jones pushing lower, Nasdaq pushing lower, the Russell grinding lower, and the US indices have had a bit of trouble over the course of this week. But we'll come back to the bond yields. We'll have a look at a pretty aggressive pullback over the course of the back end of yesterday and into today, which has created some buying opportunities of equities into the close today. Again, we go back to the 1-hour time frame. We look at pretty strong upside across the US session yesterday and the European session today. Pretty strong upside across the board on stock index. See the S&P higher, Dow Jones higher, Nasdaq, Russell, DAX, FTSE, the Nikkei all pushing higher, the VIX then continuing to push lower. Fear index, a fear gauge for the S&P 500 and for stocks in general, which then continues to push lower, which provides further relief to stock indexes, right? So bond yields higher, stock indexes lower, bond yields lower, stock indexes higher is the trade of the week, and I don't see why that would change personally into next week. The US dollar itself, US dollar continued lower over the course of last week, but across this week, pretty choppy trading conditions across the board on the US dollar. You've got the Aussie, Kiwi, Euro and Sterling in the dollar block, proving quite troublesome to trade over the course of this week. You've got dollar Swiss that had been cruising higher, but is kind of stalled up here at the highest. Dollar yen stalled, dollar CAD stalled, dollar index then itself, obviously if euro dollar is a bit choppy, US dollar index, the Dixie, is going to be a little bit choppy as well. So with those US bond yields rising higher, you'd expect the dollar to follow suit and continue to push higher, and has not quite materialized over the course of this week. So bond yields higher, equities lower, and then bond yields lower, equities higher has been the trade of this week, right? But we have seen some solid upside in the price of dollar CAD, right? Dollar CAD, the outlier in the course of today, providing us with a bit of dollar strength, but not really dollar strength as it is Canadian dollar weakness. We can jump over to this commodity chart, and you can see WTI, and you can see Brent down at the bottom, two left charts over here, showing big downside candles over the last couple of hours. Now that is off the back of reports from the Wall Street Journal that the UAE are considering leaving OPEC, right? And what that does then, it means that the UAE are no longer bound by the OPEC production quotas. It means they can do their own thing, and then they could then increase production. Obviously that makes them some more cash, so why wouldn't they do it? And that obviously then has sent the price of oil lower. You have seen it bounce back, which is natural after you see these types of moves. Big, strong, aggressive moves to the downside are normally followed suit. They normally do turn around and provide a bit of a pullback. Kind of retraced half of those moves now. Do we see that to continue lower over the course of the rest of the afternoon? Obviously we'll have to wait and see, but we will cross that bridge when it comes to it next week, when we get the answer to that question. So oil under pressure over the course of today, stock indexes flying higher over the last 24 hours, and bond yields pushing lower. So I think into next week, keep an eye on those bond yields, keep an eye on those equity markets. Also keep an eye on the US dollar, although it is not reacting how we would hope it would react off the back of these types of moves in the bond markets and in equity markets. So keep an eye on this, keep an eye on the equities, keep an eye on bonds into next week, and hopefully that will provide us with some good trading opportunities. Gold, definitely want to keep your eyes on, and oil lower. If it does continue lower, we will try and take advantage. Big downside across cryptocurrency overnight, 1 o'clock in the morning across both of these. Has not really pulled back. Some pretty big candles, big 1 hour candlesticks, pretty big dump, and it has stabilized over the course of today. Does that move continue lower? Looks like a couple of flags on both of them. Maybe we get another move lower if you are that way inclined to trade cryptocurrencies. Into next week, then we'll have a look at next week. We've got the RBA out next week, another expected 25 basis point hike. They're still dealing with similar situations as the rest of the world. You still got high levels of inflation, still need to hike interest rates to cool inflation down, and they will largely stick to the same script. Bank of Canada, we're not expecting an interest rate hike out of the Bank of Canada. They are the one central bank to then go on pause, which is maybe an influencing factor and downside in the Canadian dollar. Get downside in oil, downside in the Canadian dollar, plus you've got the central bank on hold when the rest of the central banks are not. So Canadian dollar weakness may also be a play as we head into next week. You've got Jerome Powell speaking twice. Obviously, we'll have to see what he has to say for himself on Tuesday and Wednesday. Maybe that opens the door to potentially, some direction in either side. Does he speak hawkishly and talk up the prospects of further interest rate hikes, or does he blow cold water? Does he blow cold water on it and allow make markets go that way? Obviously some upside. If you see some upside in bond yields off the back of talking up interest rates, well then that should be negative for equities. If he does not talk up interest rates and he says that he's going to and comes across slightly dovishly and shows that there is a reluctance to continue hiking interest rates, past the kind of 5.5% rate that market participants are looking at. If there's a reluctance to hike past that, or he shows a reluctance to hike past that, that again reaffirms my thoughts on them allowing inflation to run slightly hot, which is then probably buy gold. So if he comes in hawkish, bond yields higher, equities lower, I think is the trade. If he comes in slightly dovishly, pours cold water on interest rate hikes past 5.5%, well then that should send bond yields that kind of should send bond yields lower, and in my opinion then shows an allowance to keep or hold inflation at a higher rate, which maybe it's a little bit tricky to then trade gold in the short term at that point in time. But I think over the medium term, that opens up some opportunities across that. Into Friday of next week, then you got the Bank of Japan. You've also got non-farm payrolls. So again, further job figures and non-farm payrolls. I think the US central bank, the Fed, will be accepting of a slightly higher unemployment rate. Obviously, higher levels of unemployment allows inflation to cool down further, which I think will be a welcome sight. So we'll have to cross that bridge when it comes to it next week. The Bank of Japan, though, I think is an interesting one. I think the Bank of Japan, some Japanese yen longs is a good trade at some point over the course of this year. That 10-year yield capped at 0.5%. Markets keep testing it. Markets keep trying to push it above. If I'll come back to this chart and I'll just flick it up for a second. We'll go JP10Y. We'll get the ticker up and get that up. We'll blow the chart up for a second, and you can see obviously being capped. Maybe stick it on the daily time frame, but easier to see. But it's clearly being capped. That 0.5% clearly being defended, but markets keep having an attempt at pushing this higher, and they obviously keep coming in, keep stepping in and buying bonds in order to push it down. But with higher levels of inflation, with them experiencing higher levels of inflation compared to what they are used to, if that continues, well, then they're gonna need to fold that at some point. They're gonna need to raise that bar again at some point and allow interest rates to push higher further. If that does happen, if they remove a cap all completely, I'm probably not expecting that next week, but I think over the course of this year, at some point, Japanese yen longs will be a good trade, especially if that level folds, if that level pushes higher, and they even mention the word interest rate hikes, Japanese yen will go through the roof. And I think that is a good trading opportunity if it does materialize. So keep an eye on that in the medium term. Short term, maybe not the best of trades just as of now. But that's it from me then, folks. I'm going to wrap it up there. I'll let you get on with your weekends. Have a nice weekend. Do recharge the batteries and get back recharged for another week of trading next week. We'll update further next week and see what we can find. Best of luck on your trading week next week. I will speak to you soon.